Seven Deadly Innocent Frauds of Economic Policy by Warren Mosler. Proposals for the Monetary System. First, the Federal Reserve should immediately lend to its member banks on an unsecured basis rather than demanding collateral for its loans. Demanding collateral is both redundant and obstructive. It is redundant because member banks can already raise government-insured deposits and issue government-insured securities in unlimited quantities without pledging specific collateral to secure those borrowings. In return, banks are subject to strict government regulation regarding what they can do with those insured funds they raise, and the government continuously examines and supervises all of its member banks for compliance. With the government already insuring bank deposits and making sure only solvent banks continue to function, the government is taking no additional risk by allowing the Federal Reserve to lend to its member banks on an unsecured basis. With the Federal Reserve lending unsecured to its member banks, liquidity would immediately be normalized and no longer be a factor contributing to the current financial crisis or any future financial crisis. Second, the government should also remove the $250,000 cap on insured bank deposits, as well as remove regulations pertaining to bank liquidity at the same time that it allows the Federal Reserve to lend unsecured to member banks. The Federal Reserve should lower the discount rate to the Fed funds rate and, as above, remove the current collateral requirements. The notion of a penalty rate is inapplicable with today's non-convertible currency and floating exchange rate policy. Third, an interbank market serves no public purpose. It can be eliminated by having the Federal Reserve offer loans to member banks for up to 6 months, with the Federal Open Market Committee, FOMC, the collection of Fed officials who meet and vote on monetary policy, setting the term structure of rates at its regular meetings. This would also replace many of the various other lending facilities the Federal Open Market Committee has been experimenting with. Fourth, have the Treasury directly fund the debt of the Federal Home Loan Bank, FHLB, and the Federal National Mortgage Association, FNMA, the U.S. federal housing agencies. This will reduce their funding costs, and this savings will be directly passed onto qualifying home buyers. There is no reason to give investors today's excess funding costs currently paid by those federal housing agencies when the full faith and credit of the U.S. government is backing them. Fifth, have the Federal National Mortgage Association and the Federal Home Loan Bank originate and hold any mortgages they make, and thereby eliminate that portion of the secondary mortgage market. With Treasury funding, secondary markets do not serve public purpose. Sixth, increase and vigorously enforce mortgage fraud penalties with federal agencies.